Disclaimer. This podcast is for FCA authorized financial advisors only and is not for retail clients. The views expressed in this content and all other content on this channel are those of the individual speaking and do not constitute financial advice or a recommendation to invest in any product, asset, or strategy, including those discussed in sponsored segments. This content is for educational purposes only. Always do your own research and consider all relevant risks before making any investment decisions.
We think there's a great chance it could go up in value. There was a chance that it falls to zero. I mean, in my mind, that's a pretty small chance. It's fixed in supply, 21 million, compared to fiat money, which can be printed in theory in infinite amounts and in practice as much as they can get away with. There's a mismatch between the amount of money and the prices that certain goods are on the shelves for. We've both grown up where fiat money is just what you're used to. And now we have a choice.
Morning, Sam. Welcome back for part 2 of the Bitcoin IFA podcast.
Good morning. Very pleased to be here.
So,
funny. We ran out of time last time.
We absolutely did. And we've just been talking about the content for this episode. We're likely to run out of time again, but let's see how we get on. And just as a brief reminder, you are the Director of Investments at Cartwright Pension Trusts. And we're the first people to put Bitcoin within a pension in the UK. So very well placed and credible to talk about Bitcoin. Let's jump straight into the thing that we didn't really get to touch on last time, where we were discussing Austrian economics, but we really didn't touch on why we believe Bitcoin's going to go up in value. So why do we believe Bitcoin is going to continue to go up in value nominally when priced in fiat?
Yeah. So there's a few things there. So, I suppose the first thing is that the way that we look at things is that we say, we think there's a great chance it could go up in value. There was a chance that it falls to zero. I mean, in my mind, that's a pretty small chance, but different people have different views. And therefore, when we're looking at talking to clients about it, we look at both scenarios. So we're trying to do this in a very balanced way and say, look, there's this scenario, there's that scenario. It is up to you to put your weight on what you think is most likely. So, but let's focus on the positive side. Why do we think it goes up? And I think you said a very important thing there, which was in fiat currency terms. So there's a couple of things there. So to short circuit the answer a little bit, and then we can get some of the detail as to why that's the case or why it's important. There's two key elements to why the general expectations that the price will go, the Bitcoin price in pounds, dollars, yen, euros will go up over time, albeit obviously with some short-term volatility. So the two key reasons are that it's fixed in supply, the 21 million fixed ultimate supply, compared to fiat money, which can be printed in theory in infinite amounts and in practice as much as they can get away with. And then the other reason is that it's got a very low adoption rate at the moment. Estimates differ, but it's probably still in the single digits. And therefore, there's plenty of potential as with any new technology, it becomes more widespread. So, thinking back to the internet, for example, when it was, I think I saw a chart on adoption rates, which might suggest that we're, in internet terms, we're in 1999. That's all. Obviously, it's just a guess, but that's then quite interesting because we've all lived, or a lot of us lived through that, and so we can then see, well, compare now to 1999. It's it's different worlds really. So that's sort of the overview. But I think it's worth getting into some of that because people do. One of the criticisms that we get is, well, obviously we need inflation. We need the money supply to increase because it's good for the economy. And if you're coming at this from an Austrian economics point of view and probably from a Bitcoin point of view, there's a big overlap in those two groups. You're saying, no. Fixed supply is absolutely fine. You've been conned by being convinced that you need the money supply to go up. So I thought it might be worth just spending a few minutes digging into the detail of that particular point, because it seems to be quite a sticking point for some people. So if we go back a step, so we are talking here about money. So we're talking here about a good, a good that isn't actually consumed. It's just passed between us, and the value in having something that can be passed between us that we're not actually consuming is that it can then be exchanged for other things that we actually do want to consume. So I exchange some gold for an apple or a pint of milk. I'm consuming that apple, that pint of milk. That's what I'm after. I'm happy to pay for that using some money.
And the reason, just to highlight, the reason we've done that is because historically within bartering, I might have apples when I don't need milk, or vice versa. So I'm not going to exchange the apples that I have or don't have for the milk that I need at that time. Whereas if you have this good that you say that can just do that value exchange at a time when I don't have apples but I do need milk.
Exactly that, coincidence of wants or lack of coincidence of wants, which is exactly what you describe. I mean, pre-money, there's a couple of theories about what people actually did to trade and to survive. Well, first of all, there was a lot less trading, but there should have been some. So one theory is that it was barter. So you just had to try and make do as best you could, and maybe you got 3 or 4 people together and you sort of all did a bit of a barter. It worked out close enough. I guess the economy was a lot less complicated with a lot fewer consumer goods. So if you're just exchanging different types of food, or a hunting stick, then it's a different world to the complications we have now in terms of the options available. The other theory is that people kept a mental ledger. So they said, right, you're going to give me an apple now. We're both going to remember that you've given me an apple, and therefore I owe you an apple. And then when you next get an apple, you pay them back, or you say, well, I haven't got an apple, I've got a pear. Here we go, have that instead. And it all sort of works out. In practice, it was probably a bit of both. But in both of those, applying both of those theories, they're very localized. So it works quite, in a family, it worked fine, because actually, if someone forgets their mental ledger, you're one big happy family, hopefully. So it sort of doesn't really matter. You're kind of, you're there to support each other. Even a wider group with friends and family, if you've got 20 people, let's say, or 30 people, you can probably still get it to work sufficiently. And the rough edges are smoothed out by you being friends and family. But as soon as it starts being between one tribe and another tribe, or as soon as it starts being over sort of longer distances, then it gets more difficult. The mental ledgers don't work anymore. There's not that goodwill. The bartering falls down. So that's where money, I think, really becomes very useful. And then obviously we've then had thousands of years to get to where we are today.
Yeah, I mean, just to touch on that briefly, we probably had bartering, and then we used things that were difficult to get hold of and hard to produce. So seashells that had to be, you literally had to dive down to the bottom of the sea, the ocean floor, to get these shells and then slightly refine them. There's a lot of proof of work that goes into those. We've used all kinds of things: shields, swords, cattle, right, which is where we get the term chattel in financial services.
Salt is a good one.
What's that?
Salt is
Yeah,
one.
yeah. There was the island nation in. He talks about it in the Bitcoin Standard. I've forgotten what they're called, but they're somewhere over in Indonesia.
Gray stones or something like that.
Yeah, and they used the stones from another island that they had to go. They had to go over and mine these stones and bring them back. And the Westerners flooded that economy with false stones. So they said, no, we're only going to use the ones that we bring. So, and then eventually we settled on silver. And then we upgraded that to gold, but not all at the same time, to some very public detriment. So China decided to go with the silver standard when the rest of the world was going on gold, and they got absolutely caught out by that. Hi, team. A quick interlude to ask, what if you could offer your clients Bitcoin exposure on a regulated investment platform? Because that's what my friends at P1 have done. They've created a discretionary model portfolio invested into companies with significant operations in digital assets, available within general investment accounts, ISAs, and pensions, and managed by award-winning investment professionals. With P1's digital assets portfolio, you can access a professionally managed portfolio of listed companies powering the digital asset economy, such as miners, blockchain infrastructure, payment services, and listed companies with Bitcoin treasury strategies. It's Bitcoin and digital asset exposure built for regulated advisors. It's diversified, actively managed, and with full transparency. P1 created the portfolio for advisors who see the long-term potential of Bitcoin and the digital asset economy, and who are starting to look at how best to facilitate exposure for their clients. It is packaged in a way that fits into an advisor's day-to-day investment advice process. So if you're an advisor who wants to offer digital asset exposure without the operational headaches, visit the URL in the show notes or use the QR code on screen. P1, bridging traditional finance and digital assets, only available on the P1 platform and via regulated financial advisors, and the value of investments can fall as well as rise, and you may get back less than you originally invested. Now back to the show.
Yeah, India as well hung on to the silver standard for hardly much longer than they should have done. And so if you look at all those examples you just described, there's some, and you mentioned the phrase proof of work, but I'm not sure how well that's known outside of Bitcoin circles. So, but the point is, let's take the African slave beads. Actually, are quite an interesting example. So this is where the Africans, this is sort of 1600s, 1700s, and they made beads locally by hand. I don't think these are necessarily real, but these are some that I bought as a sort of demo, as a prop for some of the presentations we do. And so they made the beads hand by hand. It took a lot of work, and the effort that went into it was roughly equal to how much you could trade them for to buy food and whatever. And then the Europeans realised they could mass make these beads in Europe in factories, build the ships, went over, basically just bought everything in sight. Hence, that's why they then became known as African slave beads, because they were just being, they gave all their stuff away, and they were left with these worthless beads. Why were they worthless? Because someone was able to create them at very little cost and flood their economy. So this gets us back to sort of the fixed supply versus the inflated supply. So if we look at gold, I mean, it applies to all of the examples we've talked about. But we look at gold, the supply, or the supply increases by 1 to 2% per year, and it's hard work. That proof of work phrase you use. It's hard work to find the gold, dig it out of the ground, refine it so it's actually, maybe it's a coin or it's a bar or something that's verifiable as gold, and then add it to the stack of supply. It's hard work to do all that. And you look at the profitability of gold miners, and hopefully they are making a profit because they're putting capital to work and they're putting a lot of effort into it. But it's not like they're making and obviously the profits go up and down, but generally, you take an average over any decent period, they're not making super profits. Like they've found some glitch in the economy that they can suddenly, mine, I suppose, for want of a better word. It's hard work to do it, and it's a tough business. Whereas you compare that to central banks now producing fiat money, and it's just tapping some ones and zeros on a keyboard. There's an element of printing bits of paper and writing numbers on them. So the level of work involved is way, way lower for fiat money compared to then what you can buy with it in the economy. And in fact, there's a name for it. It's seigniorage. There's a name for the difference in value between the cost of making let's say a banknote, and what you can actually buy with that banknote.
It's called seigniorage, do you say?
Seigniorage,
So
yeah.
it's the way of quantifying proof of work, essentially. So like the amount of energy and effort.
It's like that's like their profit by creating fiat money.
Right. I'm
So
still not
let's
following.
okay. So how much does it cost to make a £20 note? I don't know. I don't actually know. Maybe it's, I don't know, 20p. I mean, you're making them in bulk. It's basically a piece of paper. It's got some, I think it's polymer or something these days. Some slightly fancy plastic, and it's got some bit of foil in it and stuff, and some artwork. So obviously some effort's gone into it. But when you make them in bulk, 20p, I don't know, 50p, but you're selling it for £20. And so the difference between the two is effectively your profit as a manufacturer of fiat money.
I see. And understood. Yeah, it's a really interesting one, and the history of gold, and as you say, there's a 2% what we call stock to flow ratio. So we add about 2% new flow every year to the existing stock. A stat I heard about gold, and one of the reasons why gold has functioned so well historically as money, is because we've actually only dug about 2 Olympic swimming pools out of the ground. So there really isn't that much of it around. I mean, 2 Olympic swimming pools in volume isn't small, but relative to the fact that there's 8-9 billion people on the planet, and there's that much gold to go around. And it's that proof of work. It's that difficulty. If someone wants to pay you for something in gold, right? So gold prices about $4,000 an ounce today. So let's say you want to sell someone a watch for $4,000 and they want to pay you with an ounce of gold. You know that there's proof of work that's gone into that gold. Either that person has had to dig it out of the ground, refine it, verify it, and then bring it to you, or that person has had to previously buy it for a lot of money. And that money that previously bought it, there is proof of work that's gone into that. In theory, they have had to exchange economic time and value to get that money to buy the gold.
I'm going to slightly contradict you on those.
Okay.
So the first one is, you say, well, there's not much of it. It's because I don't think that matters. I don't think it's that which gives gold its value as a form of money. It's more that that stock can't be increased very fast. So we could have 100 times as much gold as those 2 Olympic swimming pools. It would still be a good form of money if it's only increasing at 1 to 2% a year. And then the other point is about someone likes gold because they know proof of work has gone into it. I don't think that matters. I think it's not because proof of work has gone into the gold coin that they are now holding in their hand. I think it's because, either knowingly or not, they know it's difficult to produce the next gold coin.
I see. Yeah, understood. Because it's so difficult to get hold of new flow, we know that it's going to maintain its purchasing power and potentially go up in purchasing power.
So it's a combination of that, and a combination of, basically, it's extremely difficult to destroy gold. So it means that we've built up stocks. The stock of gold, we got the 2 Olympic swimming pools. We built that up over thousands of years. And so you've got that's partly what contributes to the low percentage growth in the supply, or the high stock to flow ratio, is the fact that we've got all this stock that basically is just, it's there. It's not going, it's not disappearing. There's a little bit into jewelry, a little bit into electronics, but basically the vast majority is just sitting there as a form of money, and it is only being added to very gradually. So that's what I think gives it its value as a form of money. Where I wanted to sort of go a little bit with this was, we've got a stock of, let's stick on gold for the moment, because maybe, and then we can expand it into other types of money. So we've got a stock of gold that is only growing very slightly every year. So, and importantly, it grows slower, that supply, than any other physical commodity. And that's why it was ultimately won the battle to be the best form of money over thousands of years, because of that, because it was better than any other physical commodity. So if we think of, I mean, again, there's theories about this, different theories about this, but um, there's the sort of the process of something becomes a collectible, then it becomes a store of value, then a medium exchange, then a unit of account. And the collectible is someone saying, "Oh, there's a nice little shiny rock over there. That looks nice. I'm going to pick that up and I'm going to hold on to that. I'm going to try and find some more of it." And then there's the store of value bit where someone says, "Well, there's a nice shiny rock there. I don't know what it's worth, but someone seems to accept apples for it, and everyone seems happy that if we don't, for whatever reason, if we don't like this shiny rock anymore, we can sell it to the weird shiny rock collector down the road." Um, and so there's still some value to it. And then of course this grows, and then it's sort of, you've got this. This is one of the difficulties about the monetary premium. What's the monetary premium in that shiny gold rock? It's all in. I mean, all value is subjective, as I think we might have touched on last time. But in most things, there's some, like an apple. There's the value is it's more obvious because I can eat it. I can enjoy that apple. Money is much more ethereal. Is that the right word? It's harder to touch. It's intangible. It's And this is why I think a lot of people confuse monetary premium with a Ponzi, because they can't actually touch it. All my life, people have always said, "Oh, I like investing in property because you can touch it. You can touch the bricks." And I think there is something human, psychological, which is that if we can see it with our own eyes, then it must be real. That's why illusionists are so popular, maybe because they're playing fun and games with that idea. But we have this, yeah. So in that gold shiny rock, there's this monetary premium, and then it's only over time that it builds, and in people's minds, and they get used to it, and culturally it becomes accepted. And then we've got it as a form of money that people then will use as they've got enough of the shiny rocks, so they're happy to spend them. So it turns into medium exchange, and then they just start counting their wealth in shiny rocks rather than something else.
I'm wondering where we are on that adoption phase, and are you essentially equating all Bitcoiners to weird shiny rock collectors? I think that's where
Well,
we're at.
it started, right? So you think, "Oh, there's this weird computer code. I've no idea what it's worth." I mean, this was before my time, but I don't know don't know what it's worth, but it's interesting. I'm gonna just try it out. I'm gonna spend some energy in mining them on my laptop and all that kind of stuff. So I think I think I think it had a clear collector stage. If we try and sort of pigeonhole a bit, um, I think there's I think we're still fairly early on in the store of value, and we're just starting to touch the left hand side of the start of the adoption for medium exchange. In fact, you could argue to try and this complicates things a little bit, but the medium exchange is sort of at the collector stage in that there's a few people out there that are willing to spend Bitcoin, but it's more so they can just have, "Oh, I was able to spend some Bitcoin," or I can then put a video on, I don't know, YouTube or something. So to show how I bought something with Bitcoin in some country overseas. So it sort of feels a little bit, it's a novelty. Maybe that's a better word. So then going back to this sort of fixed supply and inflated supply. So you got the gold. Who benefits from the increase in the gold supply? Well, at face value, it's the gold miners, because they're the ones that are actually producing the gold, but they're having to spend a lot of time, effort, cost, energy to find that gold, and actually they're making a bit of a profit, hopefully, but it's not very much. So
It's also we're going to probably touch on ESG later, but they're also destroying pristine environments.
yeah.
Moving whole populations of people, leaving cyanide and mercury embedded in that environment for years and years and years. It's not a very ESG friendly commodity to dig out of the ground these days, right? The days of gold just appearing in rivers in California in 1900 are long gone.
Yeah, that's right. I mean, I think if you apply that to fiat money as well, so you effectively a lot of fiat money can be created essentially for free, and it's a centralized body that creates it. I mean, it's at the base money layer, it's the central bank, but of course, through fractional reserve banking, the commercial banking sector also creates money. And so, but that's still a very centralizing force. There's only so many commercial banks, and they have a lot of control over that. And that's it's a crazy commercial advantage to be able to have to create money effectively out of nothing, and then charge interest on it. So, and that then takes us to the Cantillon effect, which is something which I was slightly surprised, but I received some criticism for a couple of weeks ago, and the criticism was that I can't, this is from the 1700s, this Cantillon effect theory. So obviously, it's just out of date. I mean, I don't care what year a theory is first thought of. I care whether it's right or not, or whether it makes sense or not. But anyway, this is some of the bizarre criticism I've been getting.
Remind us of the Cantillon effect.
So this is all linked to this topic, right? So this is where it says whoever is able to get, and so this was Richard Cantillon. I think he was maybe of Irish descent, but was living in France, or maybe had French citizenship. And France at that point was going through a hyperinflation or near hyperinflation time. And so what he recognized is that the people who were able to create the money were, which I think at that time was probably the Central Bank of France, they were able to spend the money first. And right, so here's an example, right? So let's say you're able to produce pound notes. No one else is. Right. So first of all, there's a massive temptation for you to print as many pound notes as possible. Secondly, when you do create those pound notes, you can go to the shops and you can buy your milk and your apples, and they've got no idea that you can create pound notes, and so their prices are what they were the day before. So you go in there, you're basically buying milk, your groceries for free. Okay, so you get a little bit carried away, and it's not just the odd few notes. You start printing hundreds of them and thousands of them, and get a little bit carried away to the extent that it starts to have an effect on your local area, and people start to notice that, hang on a minute, there's no milk on the shelves.
Everyone's got way too much money.
Yeah, so you've got more money. So the prices haven't changed at this point. The money people because there is more money, it has tricked people into thinking that there are more resources or goods and services than there actually are available. So when people go in to spend their money, the shelves essentially are emptied because there's a mismatch. There's a mismatch between the amount of money and the prices that certain goods are on the shelves for. And so the shopkeeper realizes what's going on. Now, he may not realise where the pound note's coming from. He may never have heard of the Cantillon effect. I'll be surprised if he has. But what he does recognise is, I haven't got milk on the shelves. And I can't get milk. I can't get more milk from my supplier. I've tried that already. And so the only way to then react is to, and it's of course to his self-interest as well, is to put the price up. So the prices go up, and effectively the prices reset to the amount of the supply of money that's in the economy, the local economy, national economy, world economy, whatever it is. And then things settle down because people then can't buy as much milk with the pound notes that are circulating, and everything settles down to what it was before in terms of the milk's on the shelf. Yeah, the shelves are full. However, all the prices are higher than they were before. So one of the criticisms that's often thrown around when inflation hits, and it was certainly in the papers a couple of years ago when inflation was at its recent peak, was that the supermarkets had taken the mickey in some way and blaming supply chains or Ukraine war, something like that, to put prices up. Now, I'm not saying the supermarkets weren't trying to put prices up where they could. Obviously, they will. However, they were only able to do that fundamentally because there was more money sloshing around in the economy than there was before.
We literally printed a third of all the money that had ever existed to deal with COVID. So,
yeah.
They were literally just reacting to that.
Prices go up. But the important point there is it's not, so prices going up, that's what we see. But it comes back to, actually, I can't remember we talked about this previously, but we've sort of got a fraction in my head. So we've got on the top of the fraction, the numerator is it's the pint of milk, it's the apple, it's
all of them. It's all of the goods and
services.
Yeah.
Or it could also be applied to assets. It could be equities, bonds, property, right? And the denominator is the currency unit in which we are measuring that value, that price, and that is reflected in one number. It's whatever it is, X pounds for a pint of milk. What we then don't see when the price goes up is, at face value, we do not know whether there is something going on with the supply of the good or service or asset, or whether the value of the currency is changing.
Yeah.
And the press normally focus on the numerator, and they just don't seem to get their head around at all the denominator of that.
Well, I mean, tinfoil hat time. I think they've been highlighted to not focus on the denominator, because if they did and everyone woke up to the fact that we're just devaluing the denominator, no one would accept it anymore. No one would vote for that anymore. There's actually two things that I want to say on the Cantillon effect. So you mentioned it there. But if I was smart and I had my own money printer, I wouldn't be buying milk and eggs and whatever. I go straight, nefariously, I go straight to buy the assets. Right? I want the hard, fixed, tangible things. I want the gold. I want the property. Because if I'm going to flood the system with money, those things have to go up in value because they're very hard to produce. So that's the first thing I'm going to do. And that kind of comes back to Gary Stevenson's, the reason for all of the inflation is because billionaires, and the solution is tax the billionaires. And
hey team, a very quick pause. If you're a financial advisor, wealth manager, or accountant, chances are your clients have already asked you about Bitcoin. And if they haven't, they soon will. Which is why I've created the Bitcoin IFA webinars. The webinars are designed to give you all of the information you need to confidently talk about Bitcoin with your clients. They're on demand, so you can watch them at a time that's suitable for you. They count as 90-minute structured CPD, and you'll get priority access to the Bitcoin IFA community. Head over to thebitcoinifa.com to book your webinar today. It takes less than 60 seconds. Again, that's thebitcoinifa.com to book. Now, back to the episode.
And I don't think that is necessarily the case. The billionaires have done very well from the money printer. They've just bought the assets with that cheap money. And I like to think of it as, imagine we're all in a bathtub, and the name of the game is to get as much water into our own containers as possible. And there's only one tap, and that's the government money printer. So if you can find a big enough receptacle and just stand underneath the tap, you're going to steal all of the water from everyone else. Everyone else is fighting over a finite amount of water at the bottom of the bath. But certain people who are connected as close as possible to that money printer, to the tap, are just going to, they get the free flowing additional money that comes in.
Which is the Cantillon effect in practice. And so the ones who do really well out of this are those that essentially get that money first. So the central bank is obviously doing well out of that. the banking system generally, the government, because the central bank is probably buying the government's bonds. So the centralizing powers are doing very well out of it. Large companies or people with lots of assets, as you say, actually, whether they know it or not, I mean, they may be unaware. They just, oh, that's nice, the equity market's gone up. But they are benefiting from that. So who loses? Well, the poor lose because they're living, maybe largely living hand to mouth. And so all they see is the price of their groceries going up.
Mm. Well, which in today's world, I saw something today on Twitter where someone showed that the price of steak went up 6% in 2 months, and it's currently averaging 19% a year.
Is that in the UK?
That was in the US, but
Okay.
it was
Steak's good. Steak's a good example because it's hard to quickly produce more steak. Whereas
you can't shrinkflate it. You can't add terrible or worse and worse ingredients as you can with UPF. You
yeah.
It's very difficult to hide the price of inflation in eggs, butter, steak, single ingredient foods. Whereas, and now we're getting into the second, third order effects of the Cantillon effect, because the poor are pushed towards shittier and shittier food, basically. Like the UPF. I read a book called Ultra Processed People.
Okay.
And so it's about the ultra processed food and the effects of COVID, because we had complete shutdowns in supply chains and things like that. And so all of the food manufacturers were like, well, if this happens again, we need our food, it needs to survive on a shelf for 12 to 24 months or survive in transit for 24 months. So the response to COVID was all of the food manufacturers to go and basically just fill up, anything that's made in a factory. It's just no longer food because it needs to be able to sit on a shelf for 24 months. And the things within food that are perishable, the things that make food go off, are the things that are actually food, right? It's the vegetables and the meat and the things, right? So, and they said that they were at some conference, and a chap that worked in the research department of one of these foodstuffs came up with this new taco shell, like a hardened taco shell that could sit on, that would essentially never go off. It could sit, and they all clapped. This one guy who was like this whistleblower was like, then nothing in that is food. Like nothing in that should be in the human body if it won't go off. But yeah, so we're getting into those second, third order effects.
And then so the poor do really badly out of it. They don't have any assets, so they just see the bad effect of things costing more. And the middle class suffer a lot as well, because the middle class are probably they probably got some asset because maybe they bought a house, but they got a mortgage on it. They've probably got some cash savings. So the cash savings are losing value, at, possibly a rapid pace. The property value may be going up, but if they sell that, they still need to live somewhere, so they'll just buy somewhere, and they will then just, particularly if they're going up the ladder, that's acting against them.
The only positive in that example is the debt. You mentioned the mortgage. In nominal terms, that's going down.
Yeah.
Which is how the very wealthy stay wealthy, right? Take out debt over longer periods, knowing that it's going to go down in value.
So there's some things that go in the middle class's favour. They sort of get a little bit of tailwind, but actually, on the whole, it undermines the middle class. And so I don't know enough about Gary Stevenson's let's call it theory, but what I've seen from what he seems to be looking at is the consequences and not the cause. And if he's really serious about making a difference, he should be focusing on the cause, and then the consequences will take care of themselves. But I don't know how many people really take him that seriously.
It's a really good way of looking at it, because he has jumped straight to consequence. He believes the cause of the problem are the billionaires, but the billionaires are the consequence of the money printer. There were no billionaires 20 years ago, 30 years ago. So how can suddenly some people coming up as billionaires create this problem? Then they're not the ones stealing it from us. It's the fact that the money is just being printed and devalued. The denominator is going down in value.
And also, if someone becomes a billionaire because they have delivered billions and okay, this doesn't happen that often, but someone delivers billions and billions of dollars worth of value to other people, why shouldn't they be a billionaire? I've got no problem with that. If they become a billionaire because they've um, you know been let's say politically clever, so they've got on the right side of people, they've got subsidies, they've got basically they haven't delivered the value, they've just either persuaded people that they should be paid $1 billion, then they're not worthy of that $1 billion in my mind. So I think we need to say again, it comes back to what are the causes of them having that money in the first place, not they have that money therefore.
Mm.
That's maybe a bit too nuanced for some people.
Agreed. So where have we gotten to here on this? So let's link
So
this back to, so
I
why do
want to
we
finish
think?
on one point on that, which is that, just to sort of wrap up that initial sort of topic, is that we are lucky enough now that every person has a choice, and so we've both grown up where fiat money is just what you're used to. It's all around us. Everyone uses it. We use it. We don't even think about it until we then, whether it's Austrian economics or it's Bitcoin particularly, and then we started to question, well, hang on a minute, I don't like this about it, I don't like that, that doesn't seem fair. And now we have a choice. And I would say there are three choices, fundamentally, in terms of saving money. There's three choices. So one is to carry on using fiat money, but do that with it in mind that there are some people, there's a small group of people out there who can inflate the supply of that fiat money theoretically to infinite levels. In practice, it's enough to try and not for it to be noticed too much, but as much as possible. So you whatever fiat money you have is going to be diluted in value, in purchasing power, because of that. The second option is gold. It's been around for 5,000 years or so as some kind of money. I'm sentimental towards it because it was part of, I feel it's part of my education to get to where I am today. It's the store of value aspect. There's still some value to that, I think, but it's centralizing in its very nature. It is still increasing in supply every year. They are still finding more, but we don't know how much there really is in the Earth's crust and so on. But it is hard work to find. But that is a legitimate option. And then the third option, which I'd argue is going to take over from the other two, is Bitcoin, of course. And there you can work on the basis that it's a fixed supply. Yes, there are Bitcoin miners, without wanting to get into the technical side of that necessarily, but the Bitcoin miners are sort of equivalent to gold miners in that they earn their revenue in Bitcoin. They expend a lot of energy and effort to actually earn that Bitcoin. They're hopefully making some profits, but actually they're not super profitable over a period of time. So it's very similar, but ultimately that gets us to that 21 million hard ultimate limit. So that's the choice that everyone has. Do you want to hold a money that can be debased by humans? Do you want to have one that can be debased by nature, or do you want to have one that is within computer code capped at a certain level? It doesn't matter if it's 21 million or any number, but he's got that cap. That's the choice. And then you can go back in time and look at similar situations where different monies competed against each other, and the one that won was the one that was hardest to produce more of. But if you've got a fixed cap, you can't produce any more. So anyway, so that's coming back to that original question. Really, is why do you expect? What's the positive scenario for Bitcoin? It's that essentially that 21 million limit remains forever, and it's therefore the hardest money to produce more of, and that you ultimately can't produce any more, and that then competes with money that is easier to produce, and so we'd expect value to flow to the hardest to produce money. And that's before we get into any of the, you can transfer it to the other side of the world at the speed of light.
Yeah, I think really, really good points there, Sam. I think I've literally just had the visual come into my head of this. So what we're essentially saying is the nominator is going to go up, the denominator is going to stay fixed at 21 million, right? So when we denominate Bitcoin in fiat currency, the fiat currency is just going up and up and up. So let's think of this let's go back to when we had the competing monetary systems of silver and gold. There would have been a point where whatever 1 ounce of gold equaled 2 ounces of silver, let's just say. Probably butchering the math here, but silver was a lot easier to produce. So if you're looking at it on the scale to try and find out, what's this thing worth in gold and silver, let's say it's a cow, right? And it's worth 1 ounce of gold and it's worth 2 ounces of silver. Well, over the next few years, if silver was easier to produce, in order to get that to equal again, 1 ounce of gold was going to equal 4 ounces of silver, then 8 ounces of silver, then 20 ounces of silver, whatever. So if you need that, I have a very visual way of learning and a visual memory. That's the way I visualize it. And so we're essentially just doing the same, but on this side is 1 Bitcoin, and on this side now is $125,000. And so when we're just going to print more and more dollars for those to become equal again, it just has to keep going up in dollar terms. And I think you touched on it there, which is when you have those competing monetary systems, it's a zero-sum game. One of them wins. Like eventually human consensus says, no, we're going to use this one, right? And historically that was gold. We have had centralized fiat currencies forced on us to an extent. Maybe we voted for it, but we didn't realize what we were voting for, but we didn't really vote for it. The central bank of the US was forced through in whatever it was, 1913, and we've had centralized banking ever since. But eventually humans will realize that the most valuable thing for them is Bitcoin. I think you and I both agreed on that. And it is a totally zero-sum game.
Hey team, just a quick pause to say a huge thank you. You've given us your most precious assets, your time and your attention. And honestly, it means the world to us. If you've enjoyed this episode or you take value from these conversations, it would really mean a lot if you could like, comment, or subscribe. Those things really help the algorithm and they help the channel to grow. And if there's someone in your life who would take value from this, maybe a fellow advisor or someone just curious about Bitcoin, please send it their way. You never know what it might spark. Okay, back to the studio.
And there's I think, and there's a lot of people they sort of put a lot of emphasis on it's important to vote, and it's important to protest if there's things that you don't like are going on and stuff like that. And I sort of get that. I think, but equally, it's easy for those votes and those protests to be ignored. One recent protest that I did put a post on LinkedIn on this. It seemed to get quite a few views. Was around the digital ID. So it's a personal view. I'm not in favour of digital ID. I think it gives a lot of power to people that are likely to abuse it. Maybe it's not the people that are in power now, but what about the government after them or the government after them? It's the only give powers to government with in mind that it's your worst enemy that gets into government and they could use them against you. So I think it's very dangerous. There is an argument that which some people have made to me, which I'm sympathetic to, which is, well, the government's too incompetent to use these powers in the way that you're worried about, Sam, so don't worry about it. And I'm thinking, well, okay, that gives me a little bit of comfort. But equally, if they're too incompetent to use them, why are we giving them powers in the first place? It's illogical. Let's just not give them the powers, and then they won't spend a load of money trying to implement them, and then it'll fall over if that's the scenario. So, and the alternative scenario is pretty terrible for human rights.
So I literally saw something on Twitter either last night or today, which was Keir Starmer saying that digital IDs in India have been a good idea because they've given everyone access to their money. And it felt like there was a little mask slip there that this is basically step one to CBDCs.
Yeah, I think I saw slight. You're right. So that was definitely the headline, and I watched a little bit more of that video, and I think it was slight. It wasn't quite as bad, but it doesn't take much to read between the lines. And also, I gather that's what did happen in India. You know, you needed your digital ID to get access to your money, so it's not that big a step. I mean, so it comes back. We've got this choice. So we have. So last time on part one, I described how what made me realise that Bitcoin was going to become relevant for institutions, pension schemes, companies, charities, is that it always when Russia had its $300 billion worth of foreign government bonds frozen, thought it owned something, didn't in practice. That introduced counterparty risk to G7 government bonds. And of course, it takes time to play out. But with what the gold price has been doing recently, it looks like that message is getting across. You could argue it's not as big an event necessarily, but that speech, but maybe the digital ID generally is, with the occasional mask slip on what the ultimate objectives might be or what it's used for, is the same sort of thing. A digital ID, when combined with central bank digital currencies, means that you think you own something, but you don't. You think you own your money, but you don't. And it could be taken away because of a post on X or something like that, or just you've expressed a view. Because they've looked back at these podcasts and they've said, Sam doesn't have the right views. And so then they cancel my bank account.
You're scaring me, Sam.
Well, well, maybe we need to get together at that point, and if we can buy a beer together, then we can have a beer each. But and talk about how it's unjust. So maybe things like the conversation around digital ID could act as a similar trigger for people to say, actually, I don't want to own a money that I think I own, but I don't, at the whim of someone else. So the Canadian truckers, I forgot what year it was it 2021 or 2022?
Something like
But
that,
they were protesting, peacefully protesting, as far as I could tell, and bank accounts were frozen. And a lot of them, I suspect, then found out about Bitcoin because they had a need to do so. We've all got a choice. We've all got a choice about whether we continue to use fiat money, which is devaluing at a fluctuating rate, but it's devaluing every year. It's getting less and less value. It's got less and less purchasing power every year. Also, the way things are going, it may well be that it could be taken away from us. So it introduces that counterparty risk into the money we use. So sort of drawing the straight line from the Russia $300 billion example, which was only really affected governments. This is now applying the same principle to individual people. What are governments doing following the Russia episode? They are moving into gold. And that's probably what we're seeing the gold price rise, because they are indiscriminate buyers of gold. Are they moving into Bitcoin? Well, there's the odd announcement. So Luxembourg announced. I mean, they're probably not particularly one of the countries that be that concerned about being. I'm sure they're doing it for investment reasons rather than other reasons. But the point is that they've started. Have China, Saudi Arabia got Bitcoin? I've absolutely no idea. I haven't seen any announcements, but
So
then they would tell
the
us.
Saudi investment fund, I think, bought MicroStrategy very publicly earlier this year, I think.
So the question there will be whether they just bought a broad equity index which happened to include MicroStrategy, and then someone found out and thought they'd make a press release out of it, or whether they've actually specifically bought MicroStrategy for the Bitcoin exposure. So I don't know. I don't know which one it was. But I mean, with all the oil there, I mean, they're set up, and the gas flaring, they're set up for a lot of Bitcoin mining. Would be an obvious thing for them to do. But anyway, sort of drifting off a slightly different direction there. So the point is that on an individual level, this is a shot across the bow. Digital ID and the CBDCs, which there's plenty of stuff around if you read about it, but very few people seem to have read about it. Maybe it's all just not going to happen. Maybe it'll all go to fall over. You know, we know about government IT projects. They haven't exactly got a good track record. Maybe these two will fall into the same category and we've got nothing to worry about. I hope that's the case. And I'm worrying unnecessarily. Equally, it's still a risk. It's still a credible risk that could happen. And it's a shot across the bow to say the reason why both of these things are a problem is because we're using fiat money. People now have an option. Move into gold, which has some limitations, although it's not all bad, or the better option, move into Bitcoin and hold your Bitcoin in self-custody. So it'll be interesting to see how much people sort of pick up on the signposts of what may or may not be happening, and the choices are there. It's up to people to take responsibility for themselves.
Yeah,
Don't wait for your government to save you. You'll be waiting a long time.
yeah, absolutely. Absolutely. Yeah, I think you're absolutely correct. The thing that I always say and would highlight to people, especially when it comes to things like CBDCs, programmable money, when it's decentralized and requires consensus across thousands, if not hundreds of thousands, if not millions of people, is a good thing. Because when have humans ever had consensus? If you have more than one human in a room, there are things that they will not have consensus on. So once you start having decentralized programmable money across millions, if not billions of people, and it incentivizes consensus, that's a good thing. No one person can control it. Programmable money that's centralized is a very dangerous thing, regardless of whether it's this government, the next government, whatever it is. When it's centralized and ultimately 1, 2, 3, 4, 5, however many people are in control of it, if there is one thing that human beings have proven for the last 200, 300,000 years, 500,000 years, whatever it is that Homo sapiens have been around, if there's one thing that they have consistently proven, it's that humans are corruptible.
Yeah.
And so centralized programmable money is a real threat. And as you say, Bitcoin offers an opportunity to opt out. Sam, we have covered one of the list of things that we wanted to talk about today, and we're out of time. So we are definitely going to have to do a part 3. This may end up becoming your sailor series on the Bitcoin IFA podcast. So
too high a bar. Let's go lower.
So, thank you very much, Sam. We'll be back for part 3.
Cool. Thanks, Dan.